The average equity investor has underperformed the S&P 500 by roughly 4 to 5 percentage points annually over the last few decades. That's according to Dalbar's research. The market returned around 10% per year. The average investor captured closer to 6% per year. If you invested $100,000 over 30 years at 10%, you would have $1.7 million. At 6%, it turns into $574,000. That's $1 million difference. And the culprit isn't bad stock picks or market crashes or even fees. It's psychology. People buy and they sell at the wrong times. They chase performance, they panic, and make emotional decisions that quietly destroy their wealth over decades without ever realizing it's happening. That's what we're going to get into more today. The uncomfortable truth is that the instincts that kept your ancestors alive are working against your portfolio today. Loss aversion is the deep fear of losing what you have. It made sense when losing resources meant starvation. In investing, that same wiring can keep you on the sidelines, watching inflation erode your purchasing power while the market compounds without you. Recency bias is the tendency to assume that what just happened will continue to happen. It made sense when reading weather patterns in nature kept you safe. Markets, unfortunately, don't follow the same logic, and past performance certainly doesn't predict future results, even when it feels like it should. Confirmation bias is the pull toward information that confirms what you already believe. It made sense in tribal environments where changing your views could get you ostracized from society. In investing, it just keeps you committed to the wrong thesis longer than you should be. Knowing about these biases helps, but it doesn't make you immune. I'm human too, and I felt the pull of all three of these things at different points. What changes with experience is having a framework that forces a pause between the emotional impulse and the actual decision. We'll get to that. First, let's walk through each one of these in a little more detail. We feel the pain of losing $100 about twice as strongly as the pleasure of gaining that same $100, according to research done by Daniel Kahneman and Amos Tversky. Work that eventually earned Kahneman a Nobel Prize in economics. Think about what that asymmetry does to decision-making over a lifetime. The S&P 500 is up over 80% in the last 5 years. And there are people who watch that entire rally from the sidelines. After COVID, the concern was a prolonged economic shutdown, then supply chain chaos, then the fastest interest rate hiking cycle in decades, then regional bank failures. After that, an escalating war in Europe, then political uncertainty around elections, then tariffs that threatened global trade. At every single point, there was a credible, rational-sounding reason to wait on deploying capital. The market went up dramatically despite all of it. Loss aversion framed every piece of bad news as a reason to stay out, and real information became a justification for inaction rather than a prompt for thoughtful decision-making. Over 5 years, that cost investors enormously. Recency bias is the tendency to assume recent trends will continue, and in markets, it creates a predictable and expensive doom loop. Warren Buffett once said, "You know you're in a bubble when you see people that are dumber than you getting richer than you." That stings, and that sting is exactly what drives FOMO. Here's how it plays out in practice. Let's just say a technology company surges several 100% because the narrative is that AI is taking over the world. This company is at the center of it, and anyone who doesn't own it is going to miss the defining investment of a generation. Buying this name feels obvious. The story is compelling and the trend is clear. Meanwhile, a company whose stock is down 50% feels toxic. Clearly something is wrong with the business or it's being disrupted. Who wants exposure to a business like that? Both instincts are understandable, and both can be completely wrong. The surging tech company may already have years of optimistic growth priced in, meaning you're buying the peak of the narrative rather than the beginning of it. The company that's down 50% may have faced temporary headwinds that the market dramatically overreacted to, and now trades at a fraction of its actual fair market value. Recency bias tells you the recent trend is the signal. Often, it's the noise. This pattern has repeated across different assets in different eras. Think about the tech bubble in 2000, when the internet was going to change everything and any company with a .com in its name was worth buying. Think about housing in 2008, when the prevailing wisdom was that real estate will always go up. Crypto in 2021, when blockchain was going to replace the entire financial system tomorrow, and missing it felt like missing the internet in 1995. Significant appreciation, intense FOMO, new money rushing in near the peak, then a sharp reversal. And when it reverses, that's when loss aversion kicks in. And the same investor who bought high panic sells near the bottom. At this point, the loop is complete and the damage is done. Confirmation bias is a bit subtler than the other two, and in some ways more dangerous because it masquerades as research. and investment diligence. Someone develops a strong point of view. This political administration is going to destroy the economy. A trade war is going to crater markets. Interest rates are going to stay high forever. So they find the analysts who agree with them, the articles that support the thesis, the commentators who tell them what they want to hear. Over time, they become increasingly certain that they're right. Then they make large, concentrated bets based on that. And when they're wrong, which happens frequently because markets are genuinely hard to predict, they lose money, oftentimes a lot of it. The whole process feels like you're doing your homework. You read extensively, built a well-reasoned case, and you were still wrong because you were selectively curating information without realizing it. That's what makes it so costly over time. According to Vanguard's Advisor Alpha Research, behavioral coaching is worth roughly 1.5% per year in added value. That's more than portfolio construction, more than tax efficiency, or any other single service they measured. The value an advisor provides in this context isn't superior intelligence. It's distance and a process. When your portfolio drops 20%, you feel it viscerally. A good advisor has watched this play out across many clients and multiple market cycles, and can recognize it as normal volatility rather than a signal to take action. When FOMO is overwhelming and everyone seems to be getting rich from something you don't own, a good advisor has seen enough of those situations end badly for late entrants to push back on the impulse to buy. When your conviction about a market call feels airtight, a good advisor has seen enough confident people be wrong, themselves included, to stress test it rather than to validate it. As I said at the start, I feel these things too. What changes is having a process that doesn't require real power in the moment. Rules-based rebalancing, pre-committed guidelines for what to do when markets sell off, a framework for evaluating new opportunities that separate the signal from the narrative. These aren't exciting, but they do work, because they don't depend on staying calm when staying calm is the hardest thing to do. The biggest threat to your wealth over the next 30 years probably isn't a market crash or a bad investment. It's the accumulation of small emotional decisions that each feel justified. If you want to talk through what a behavioral framework looks like in practice, you can book a call through the link in the description. I hope to speak with you soon. Thank you.